sacrifices, play this game. I done prayed that my life would never be the same. I done prayed that I will make it bring glory to my name.
Ladies and gentlemen, welcome. This is another episode of Uncle Strib, and today we have an exciting topic, a topic I get asked about a lot. We're going to talk about investing, and more specifically, investing in the stock market. There are a handful of different ways to invest, but today's going to be primarily focused on the stock market, simply because I think it's one of the easiest things to do if you do it a certain way. But that's what I'm here to talk about. But first, I have to say this legally. I'm not a financial advisor. It's just my personal opinions and experiences. And remember, there's always risk to investing. Nobody knows exactly how things are going to work in the stock market. So there is going to be ups and downs. And some people lose all their money. Some people lose some. But the risk is there. Nothing's guaranteed. But with all that being said, time to get started. So I've been investing for quite a minute, about 9 years. I started 2014, so it'd be at 10 years next year. And I have a pretty solid real estate portfolio, as well as some money in the stock market and a little bit of crypto. We're not touching crypto because I view crypto as more of a gamble than anything. And I view investing in the stock market as more like a calculated risk. Crypto, it's gambling. It's the wild, wild west. But anyway, to get started, I have my notes here. We're going to go over some few definitions. So when I start saying these words, it's not a foreign language, because this is really for the people that are straight beginners that have no prior knowledge to how the stock market works, what it is. So we're just going to go over some basic definitions. So obviously the first one is, what is a stock? A stock is owning a piece of a company. Right? So a stock is only a piece of a company if the owner of that stock is a shareholder. So for example, I own shares in Ford. I own multiple stocks in Ford. Therefore, I'm a partial owner of Ford company, right? And stocks you're able to buy stocks for publicly traded companies. Some private companies, if you work there, you have stock options where you're able to get stocks through that. But we're purely talking publicly traded stocks on the stock market. That's what a stock is, like owning a piece of a pie. A bond is loaning your money to a government or corporation with a fixed time span and a fixed interest rate. This is essentially, you're the bank. Usually when you go to the bank, you get a loan. You get a loan with a specific interest rate, yada, yada, yada. A bond is the reverse of that. You're loaning your money out to a corporation or the government with a fixed time span, usually 3 or 5 years, and a fixed interest rate. And it's pretty safe. A bond's pretty safe because they're going to pay back that money over the time span with that interest rate. A mutual fund is a managed fund that pulls money together from investors, and that money gets invested into different things. So if you can imagine, a mutual fund is basically, let's say you have 10 people in your family, they all put money in a basket. Somebody that manages that fund takes that money that everybody put in that basket, and they go invest it. And when that investment returns its money, however, if you put in 50% of the money into that mutual fund, and all your other family kind of sprinkled in, and they have 50, then you're going to get 50% when the money gets paid back, you're going to get 50%. So it's all dished out in however much you contributed to that mutual fund. Index fund is a specific type of mutual fund, which is a fund that seeks to track the returns of a market index. So an index is basically, like you can imagine, a mutual fund, but it's comprised of specific companies. So the S&P 500 index is a mutual fund that has the top 500 companies in the stock market. And that's what the S&P 500 is, the top 500 stocks in the stock market. And that's what the S&P 500 index does, is it's gonna simulate that market. So if that market's doing well, the S&P 500 index is going to go up. If the market's doing bad, that index is going to go down. You can invest in the whole index. An exchange trade fund is a fund that holds multiple stocks. So again, it's a pool. They pull all this money together, and you put that money into an ETF. So an ETF is essentially an index fund, but it's able to be traded like a stock. So mutual funds and stocks are not all traded the same. Depending on where you go, you can buy one full bond or that's a fixed rate, or you can buy one share of an ETF. It's going to get complicated, but just understand pretty much stock and ETF are going to be the primary focus for this. Hey, chill out. Sorry, it's my dog. But anyway, just understand the stock is only a piece of a pie, and an ETF is like buying a bunch of different things, but you can just buy it in a single share. And I'll explain ETF later because that's where I primarily focus my time and money on is ETFs, exchange trade funds. A few more definitions. We have dividend, which is money paid to shareholders. Not all companies pay dividends, and the payout of dividends change. So some pay monthly, some pay quarterly, which is 4 times a year, and some pay semi-annually, twice a year, or annually, once a year. Not all companies pay dividends, but companies that do, it's great. So if you just for owning that piece of the pie, when that company gets its revenue, it gets distributed back to you as a shareholder because you're a partial owner. So obviously it's not going to be a lot depending on how much you have. If you only own 0.01% of an entire company, then you're only going to get 0.01% of the money allotted back for dividends. Appreciation or depreciation. Appreciation is the overall increase in the value of a stock. So if a stock started off at $5 a share, at the end of the year, it's $5.50, then it appreciated 50 cents. Depreciation is the opposite. If a stock was $5 and at the end of the year, it's $4.50, it depreciated 50 cents. Volatility is basically just the kind of the up and downness of a stock price. So if a company is very volatile, if you look on its chart, it looks like a bunch of lines. If it's very up and it's very down over certain periods of time, it means it's very volatile. The opposite of volatile is stable stocks. There's not a lot of up and down. It's kind of small spikes here and there, but it gradually trends up or will gradually trend down. Those are lower risk. So high volatility is usually higher risk because it's so volatile. It's so up and down. If you catch it at a down and it goes up and you sell it at an up, if you buy it at a down, you sell it at up, since its volatility is high, it's going to have bigger jumps from up to down. Those are going to be higher risk, but they're going to be higher reward if you buy low at a very low and you sell it at a very high. Inversely, the stable ones, if you buy at a low and sell at a high, you'll still be winning, but that low to high ratio is going to be smaller because it's not as volatile. And that's going to be kind of getting into the difference between short-term and long-term investments, we'll get down later. Last two, bear market. Bear market is prolonged drop in investment prices. So if you look at the stock market and it's trending down on the chart, then that means it's going down. Bear is down, bull is up. So bear market is prolonged drop in investment prices, generally by 20%. So when the stock market is dropping and it's getting to 15, 20% over, let's say 12 months, then you could consider it a bear market. A bull is the opposite, is the prolonged rise in investment prices, generally by 20%. So if you look at a full year of a company's stock price or the stock market stock price, if it's gone up 20% over 12 to 14, 15 months, then bull market. Now that that's all out the way, start with the fundamental question. Why is it important to invest? There's a handful of reasons, and I think it really comes down to the individual, but for most people, it's generally just for financial freedom. When you invest, the goal is to create financial freedom where you have enough money invested to where it's generating enough money for you to work less and be able to do things you want. Or if you don't want to work less, it just gives you more money to do things that you want to do. Second is just to create wealth or generational wealth. That's essentially what I'm trying to do. I'm trying to create generational wealth. And so the reason why you invest is you put in a ton of money to where at some point that money is making you so much money to where you're creating enough money through your investments to where you can pretty much set you and your family up for life. I'm going to get into some examples later of different like generational wealth and how the money actually works when it's invested. But those are just a second reason, primarily one of my top reasons why I invest. My second one, which is the third point, is retirement. If you have a 401k, that's a form of investing. You're putting money, that when you put money, or when money is taken out of your check to go into a 401k, that money is invested. And for a 401k, it's usually invested fairly moderately or very low risk because it is a long-term deal, which again, we'll get into short-term versus long-term. But that money's invested. So when you retire, the money the money that's made off of your 401k is what you're living off of when you retire. That's how that works. Some people can hit that generational, and that could create generational wealth. Like if you spend the principal, or if you spend the interest, not the principal. We'll get to that later. But that's essentially what retirement is. Some people make enough money to where they can hit that early through just their, not even the 401k or the Roth IRA. If they just have their investment portfolio, some people get to the point their investment portfolio itself generates $80,000 a year in dividends and payments. You'll literally get a paycheck every quarter let's say for every quarter you get a paycheck that's 20K. Well, that 20K every quarter, you can live off of that. Some people hit that when they're 30 or 40. That's what creates generational wealth. And then that's what allows people to retire early, because if you live a lifestyle where if you live a $80,000 a year lifestyle, then you can retire when your investments make you $80,000 a year. That's retirement. And the fourth reason, which people don't really think about, but is important to why you should invest, is money loses value over time. Just for an example, I have an example here for you guys. From 1960 to 2021, the average inflation rate was 3.8% per year. For math's sake, we'll round it up to 4%. But overall, the price increase was 829%. So an item that cost $100 in 1960 in 2021 would cost $929. That's a huge increase in the value, or the huge increase in inflation from 1960 to 2021. And so what that means is, if you, let's say in 1960, you put $100 in a savings account and you just let it sit, right? It's not invested. It's in a savings account. They give you like 0.01% or like 0.5% in interest a year. So with $100, it's not going to go up very much from 1960 to 2021. Maybe $1. I haven't done the math, but it's not going to go up. It's pretty negligible. But that means that $100 sits in your savings account. If let's say you're saving up for an item back in 1960, that was $100, and you put $100 in, and you're going to wait to buy that item. And let's say you waited until 2021. Oh, you know what? I'm ready to buy that item, whatever it was. Let's say it was an action figure for $100. Well, now that item is no longer worth $100. It's worth $929. So your money loses value when it's sitting in the savings account, or if you just have it in cash. That's why that's why people tell you you're not supposed to just keep cash. Now, there's nothing wrong with having cash if you need liquid assets. Liquid is just how quickly can you get something to cash, right? So if you have money in your savings account, that's very liquid because you can use it right now. If you have money tied up in investments, it's not as liquid, because sometimes it might take, depending on what it is, like my investments, they're semi-liquid. They're not crazy. It takes me 3 days to get my money into my savings, my bank account. So if I have an emergency, I need money right now, that money's not very liquid. But if it's something where I need my money like a week, then I'm fine. And then in my investment portfolio, I have to wait, I believe it's 5 years before I can pull money out, which is not very liquid at all. Now, granted, I could do it by taking a fee and a penalty percentage, but if I wanted all the money out without any penalty, I have to wait 5 years. That's very not liquid, right? But anyway, that was a word I threw in there that I should give the definition to. But that's why you're not supposed to just keep cash. If you're saving things for the future, you don't want to keep cash, because it's losing its value by 4% every year, right? So money sitting in a bank account, again, having money in a savings account to save up for something short term is fine. Emergency fund is fine. Maybe you're saving up for a down payment and you need, to save up, then that's fine, because you don't want to throw that money into the stock market, because again, it goes up and down. So whenever you need it, it might be on a downturn. So if you're looking just to put something aside for a down payment, short to medium term, that's fine. But if you're saving for your retirement, putting your money in a savings account to build up for your retirement, that doesn't do you much good in the long run, because every 4 years or every year you're down 4%. And so just as an example, let's take, again, if you put $1,000, let's say you put $1,000. I have an example. It's somewhat complicated because I got numbers, but stay with me. Let's say you put $1,000 into the stock market. The average return for the stock market is about 8%, right? So you make 8% in the stock market year over year versus 0.5% in the savings account. Now let's take into account the inflation. So if you put $1,000 in the stock market and you make 8% a year for 10 years, but it goes down in value, the dollar goes down in value 4% every year. So your net gain, it goes down in 4%, but you go up 8%, you're positive 8% a year on your interest, on your interest that you get for your return on your investment. That means at the end of 10 years, your $1,000 is going to be worth about $1,480. Now, again, this is taking into account, this is including the inflation into that number. Obviously, it'd be worth more than that, but we're taking the 4% from inflation. So your $1,000 will go as far as $1,400. It's going to actually be more than that, because inflation is not something that's actually taken out of your money. But anyway, you get what I'm saying. The $1,000 in a savings account over 10 years is still going to be $1,000. $1,000 in the stock market after 10 years, it's made $480 without you adding anything to it. Just letting $1,000 sit for 10 years, it's up almost $500 without you touching it. That doesn't include the things we'll talk about later, where be consistent in adding more money, because the more money you have, it's a percentage based. So the more money you have in, the more that percentage is more money. So 5% of 1,000 is less than 5% of 2,000, 3,000. So you want to keep adding it. But anyway, that's later. Moving on. I always get asked this all the time. The best way to start if you're brand new, if you don't know anything about stocks, you don't know how to move in the market, what are the things to do if you're brand spanking new to get started? Because the most important thing is starting now. The value of compounding interest. Compounding interest is taking the money you made from your investment, that interest you made, and just putting it back into the investment. It's called reinvesting. That's so important to start early, because even if it's not a lot, I always tell my friends that ask me about it, $1. You can I start off with $5 in my account. That's all I could do is $5 here and there. Start off 10, then 20. You know, it's gonna add up, and eventually it's gonna start working for you. But the best thing you can do is, everybody has a smartphone. How I started. This is how I started. I downloaded this app called Acorn. First of all, and then I'm not sponsored by any of these apps. This is just how I got started, and it was safe and easy. It was safer and it was easier for me. I downloaded this app called Acorn, and I downloaded Robinhood. So Acorn is kind of like Acorn's the simplest way. It's very hands off. You download Acorn, you put your money into the account, and it just invests it for you. When you sign up, it asks you all these questions about your risk tolerance level. So are you willing to do high risk, high reward? You want to do moderate risk, moderate reward, low risk, low reward. Based on what do you want to do. Obviously, high risk, high reward. If you're trying to make more money now, usually when you're younger, you'll do high risk, high reward. If you're older, you'll do low risk, low reward. But there's different things to go about it. Also, if you're in it for, like, when we get to, where is it at? Short term versus long term, we'll talk about that. But which is next, which is perfect. But anyway, download Acorn, you put in your $50, it will invest the $50 for you after you answer all the questions. You do nothing. You just put the money in, and then every time you log in, it'll tell you how your portfolio's doing, the performance, it'll tell you where your money's invested. So it's not like it's a cloud of smoke, you don't know what's going on with your money. You can look to see where your money's invested, how each wherever your money's invested, you can see how those individual things are performing. That's how I started. When I didn't know it, I just started. Acorns, $100, whatever you put in, it's gonna do all that for you. If you want to rock with that long term and just use that as your retirement account, then you can do that. Because when in Acorns I was getting dividends, I obviously set up to reinvest it. So once it would give me $5 that I made, that $5 would go right back into the investment, because I wanted to compound until it gets to a certain point. I started off there. If you want to rock with that, you can. You know, if you want to take a certain percent of your check, which we get into how much you should invest later, certain percent of your check, put in the Acorn, hands free. So it's literally that simple. Robinhood, on the other hand, if you download that, and then I downloaded Robinhood next. Robinhood's a little more hands-on, but there are certain ways to do it where it is hands-off and you don't have to do too much. But Robinhood, you can invest in individual stocks and you can invest in ETFs and things like that. Robinhood also has retirement accounts like 401ks. I personally have a Roth IRA with Robinhood. Just quickly, a Roth IRA is when you put money in. It's kind of like a 401k. You put money in, and then once you get to 65 and retire, you're able to pull that money out. A Roth IRA, you pull the money out, it's tax-free. You pay taxes on the money you put in. When you withdraw, it's tax-free. A traditional IRA is the opposite. You don't get taxed on the money you put in, but when you withdraw it, when you retire, that money's taxed. For me, I prefer to pay taxes now, and then when I go to withdraw, for it to be completely tax-free, so I go to Roth IRA. That's what those are. I'm not going to get too much into 401ks and Roth IRAs and traditional IRAs because this is more just the stock market. Anyway, Robinhood, you can invest in individual stocks or in ETFs. And again, we'll get into ETFs a little later once we get to talking about the sectors, because ETFs are to me, they're very, very important, and they're very simple, and it kind of takes the guesswork out of things. But what I did is I got into Acorns, and then what I did is I did some research. I started watching YouTube videos, reading books, reading articles, following Yahoo Finance on YouTube, and I was soaking up all this information about the stock market, how things that happen in the country affect the stock market. Once because you're gonna have to do some research on your own. I guess you could hire somebody, but honestly, this isn't that hard. Once you sit down and do a little bit of research, it's not hard at all, to be completely honest with you. It's really not. So I don't think anybody should pay, if you're going to do a stock market, I don't think anybody should pay to have somebody do the stock market thing for them, unless you're looking for something very specific. But honestly, the average person, I don't think you should have to pay to have somebody do this when it comes to stock market, okay? But yeah, download Robinhood. Once I did research and I started to understand stock market work, I eventually kind of leaned away from Acorns because I wanted to be a little more hands-on. So I ended up taking the money from my Acorns and putting my Robinhood. And right now I just have Robinhood in my real estate portfolio. I don't have Acorns anymore. But again, Acorns is a great app if you just want to if you don't care about none of that, you just want your money to grow and want to be completely hands-off, Acorns is where it's at. But now I'm at Robinhood. Now that I have Robinhood, we're going to talk about the two types of investing. We have short-term, long-term. Short-term is just essentially like day trading. Day trading, you're sitting in front of the computer. When it drops low, you try to buy as many as you can low. And then when it goes up, you'll sell high. And you just try to buy low, sell high. Buy low, sell high throughout the entire day. And you have a profit at the end of the day. That's day trading. I don't day trade. I'm not an expert in day trade. I'm not a specialist in day trade. I don't day trade at all. So that's all I'm saying about the short-term and day trade. It's for the very, very, very advanced. Day trading, I believe you should do long-term investing until you figure out and understand stock market works. Then I say you could get into day trading. But day trading is for very advanced people. You got to really know and can just feel the stock market. And there's also long-term investing. Anybody can do long-term investing. And I think long-term investing is so simple. It takes pretty much the guesswork out of investing. It simplifies it. I believe investing to people seems complicated because people will talk to day traders and will hear like how complicated it is to put in stock options and want to specific prices to buy and specific prices to sell. You said you got to watch it. That becomes complicated. Long-term is just when you buy a stock and you hold it. That's it. That's literally it. You buy it, you hold it 5, 10 years, 20 years. You hold it for the rest of your life. And you just reap the benefits of the appreciation and the dividends if you're buying dividend-paying stocks. Again, we're going to get into that later. And so that's pretty much the difference. And I believe short-term is obviously a lot riskier. Long-term, generally, if you look at the stock market as a whole, generally long-term, for the most part, always wins. If you look at the the stock market from 20 years ago, it is way up. It has ups and downs on the market, but generally, if you look at the big picture, it's a trend up. That means over the long run of 10, 20 years, your money is going to be in the green. Generally, and then we're talking about the whole stock market. Individual companies, it gets a little different, but that's where ETFs comes in. So before we get deep into ETFs, what is the stock market? The stock market is composed, like I said, it's all of the publicly traded companies, and each company can fit into one of 11 sectors. So imagine the stock market is a giant piece of pie. There's 11 slices of pie, and each company fits within one of those slices of the pie. There's 11 sectors. So utility, consumer discretionary, consumer staple, energy, healthcare, real estate, materials, financial, technology, communications, industrial. What I love about ETFs is you can buy ETFs that represent an entire sector. So you can buy an energy ETF. Energy ETF is going to be the top. You can look, I wish I could pull it up, but basically, if on Robinhood, when you go to an ETF that's in energy, it will tell you how many companies are in that ETF. So for an example, let me go to, here's the energy one. So the energy ETF, it's the top 115 energy companies in that sector. So that's going to represent how that sector is doing. So here, I can actually show you this real quick for people that are watching. Here's Vanguard Energy ETF. I personally like to just stick with all the Vanguard ETFs because Vanguard's a pretty credible, I believe it's a brokerage. But anyways, you can see it's 119 right now. Today it's up 55 cents. But let's go to how it's done over the past 5 years. So you can see the past 5 years, it's up 29%. So that means if you put $1,000 into this ETF 5 years ago, you'd be up 29% on that. And as well as you can see here, energy sector, 99.58% energy, some basic material utilities. And if you go to top 10 holdings, it tells you the top 10 companies in that energy sector. So you can invest in specific sectors. So I believe the most lucrative sector, in the past 5 to 10 years is the technology sector. Yes. So we go to the technology sector. It is up the past 5 years. It's up 125%. So if you look at the price of this, ETF. Let me just say the price of this ETF from November 30th, 2018, it was $182 per share. Now it's $379. So imagine if you had multiple shares of that, it'd be a huge increase or appreciation in your portfolio. Again, here's the sector, top 10 holdings. Top 10 holdings, you can see Apple's up there, Microsoft, Visa, Broadcom, Cisco Systems. So it breaks down the holdings for that. And that's the whole sector. Now, my favorite ETF, so I'm not invested in any of those at the moment, but the ETF I am in, that's probably my favorite, is the VTI. It's the Vanguard Total Stock Market. It's the entire stock market. So if you can see here, let's look at the past 5 years. Past 5 years, it's up 51%. And if we go down here, it breaks it down by sector. It has every sector. All 11 sectors are in this. And it shows top 10 holdings, obviously Apple, Microsoft, Amazon, Tesla, because we know Google. Those are the big boys in the stock market. But one of the reasons why I love this ETF is diversity. You don't want to put all your eggs in one basket. You don't want to invest in one company. If you invest in one company, you never know what happened. Like recently, the Silicon Valley Bank went out, and we all know the things like, obviously, I was gonna say GameStop, but we know what happened. If you guys that don't know with GameStop, I'm not gonna talk about GameStop, but there are certain companies that were big that are praising no longer business. Blockbuster. So investing in one company and something might happen in that company where it goes down. Investing in one company, putting all your money in one company is very, very, very risky. Now you can do what you want, your money, but it's very good to diversify your portfolio. I don't like to have all my money in one sector. I don't like to have all my money in one company, for sure. And I don't like to have all my money in one sector. So I like VTI because it is the most diverse portfolio you could literally have, because you're invested in every single sector and you're invested in pretty much every company that's publicly traded. I meant to show you with the VTI, it tells you right here, number of holdings. If you see that, 3,948. That means there's 3,948 companies in this ETF, and all of them are distributed between all 11 sectors. So right now, because of the banking crisis, the financial sector is hurting right now. But the overall stock market is doing fairly well. Over the past week, it's up over the past month, it's up 4%. Even though the financial sector is hurting because of the banking crisis, but because it's not just this doesn't have just the financial sector, it's all of them. All the other sectors have been doing pretty much fairly fine. So that's why it's very important to diversify, and that's why I'm big into ETFs. I also have a little bit of crypto, but I'm only invested in one individual stock right now, and that's Ford. I love Ford. It's a very stable stock, and they pay pretty good dividends. And the rest that I have is in cash, because in Robinhood, you get 4.4% APR. You get 4.4% interest if you have gold on your cash. So my cash is earning interest too. And I keep a little bit of cash in there just to keep the portfolio fairly stable. So I have it broken up like that. But that's the importance of being diversified. Now, how to know if a stock is right for you? Again, that's going to come down to your risk level. So when you look at a stock, first, stocks have ticker symbols. So like Tesla's ticker symbol is, if I can find it, I believe is it TES? Tesla's ticker symbol is TSLA. So let's say you wanted to invest in Tesla and you want to decide if it's a good stock for you. First, you'll look it up. This is Robert. And again, this people that are watching on YouTube, you can see this. I'll try to narrate as much as I can for the people listening. So if we go, I always go to the 5-year and see how it did. Over the past 5 years, it's up 826%, which is ridiculous, okay? Now, if we scroll down, you can look and see these different stats. Okay, for me, it's not a stock that's for me because it doesn't pay dividends. I want dividend paying, so I want to check every time, every quarter. I want to check for holding that company. Anyway, we have analyst ranking. So right now, it's a buy. 53% say buy, 36% say hold, 11% say sell. So if you're looking at Tesla and you're wondering if it's a good stock for you, over the past 5 years, it's done well. It doesn't pay dividends, but if that doesn't matter to you, then that's fine. And the 52-week high is 364, and the 52-week low is 101. It's 185 right now. So when you want to look at the best price range for a stock, this, again, that's why 53% say buy. It's not a bad price. And so I'm going to go over what these stats mean later, but just to show you, 52-week high means over the past 52 weeks, the highest that it was priced. The 52-week low, over the past 52 weeks, the lowest it got down to was 101. So right now, it's 185. So you can get Tesla stock right now on quote-unquote discount. You don't really want to buy at the 52-week high, because if that's its peak, it's coming back down, then you're getting it at retail value. You want to try to get, basically you want to view is you want to try to buy stocks at you want to buy stocks at wholesale, not retail, if that makes sense. Or you want to buy them at retail, not resale. however you want to think about it. You want to try to buy at a decent price, which right now, 185 is a good price for Tesla because it was 300 plus. So if that makes sense to you, then buy Tesla. For me, I don't buy anything that does not pay dividends. So I wouldn't buy Tesla stock, even though technically I have Tesla stock because my ETF puts money in Tesla, but I get dividends from my ETF. That's another thing why I like ETFs, is because you can be invested in growth stocks, which are stocks that have high trajectory and value. Usually big growth stocks don't pay much dividends because the money that you would get for dividends gets put back into the company. So generally companies that pay dividends some of them still grow, but generally if they pay dividends, the growth is not as strong of a curve as the companies that take that money and put it back into the company. But that's how you can judge if a stock is right for you. I wish I could find a bad example of a stock that would be not a good example. Okay, I found one. I used to be invested in Snapchat, so I thought it was going to be this next big thing. But let's go to Snapchat. Here's the thing. So we look at Snapchat. Right now it's $10.85. Over the past 5 years, it has gone down 24%. That's no bueno. No good at all. If we look at its 52-week high, 35, 52-week low, 733. So not bad to buy. If you want to buy now, that's not a bad price to buy it at because it's still on discount because it was $35. But here's another thing. You're down 24% over the past 5 years. So that means it has a track record of losing money. Let's just say it's basically your return, you're negative 5% every year. We'll round up to 25. 25 divided by 5 is 5. So that means the value of, if you have money in Snapchat, you're losing money. You're negative 5% every year. Not good. Not only that, it doesn't pay dividends. And obviously its price earnings ratio, which we'll get into that, is negative 11. We'll get to that later. And if we go to the analysts, 14% say buy, 79% say hold, 7% say sell. And, well, I won't get into that. They don't pay dividends. So if you're looking at Snapchat and you're somebody that's looking for long-term growth and long-term increase your portfolio, you wouldn't want to get Snapchat because it has a trend of losing money or your portfolio going down 5% a year. That's not a stock you want to be invested to. So that's kind of an example of how, at least I look at this somewhat. I look at a lot more things, but kind of a simple example of how I can just look at a stock, look at its 5-year track, or it's some places you go, you can actually hit an all where it'll show 15, 20 years to see. But that's how I can just click 5 years. How's it done? It's only gone up 1%. Okay, if it's gone up 1% over 5 years, it's fairly stable. It's not negative, it's positive. But if it doesn't pay dividend, I don't want a stable stock that doesn't pay dividends. If I get I have no problem buying a stable stock, but it has to pay dividends. Or if it has to pay dividends, if I want to get a stable stock. So a stock that's gone up like 1 or 2% over 5 or 10 years, but if it's paying me dividends, that dividend will give me money. It's going to make up for staying the same price. Stock stays the same price, but it's paying you 60 cents a share, and you got 100 shares, now you're making money. You're not losing. As long as you're making money and not losing money, it's still a win. I want to say, before I get into the next thing, okay, yeah. So that's why, again, Ford, one of my favorite companies. If we look at Ford over the past 5 years, it's gone up 10%. So that means it only goes up 2% a year. So I wouldn't consider that a growth stock. It's fairly stable. It's more or less the same price over the past 5 years. Not too much. I mean, 2% is better than nothing, but it's not a growth stock. But if we scroll down, Ford pays a dividend of 9.47% a year, or a quarter, I should say. So if we're looking here down to the expected earnings is 40 cents. So that means at the end of this quarter, I'm expecting, and then they'll share what the actual number is because it doesn't always match. But they're predicting that Ford is going to pay out 40 cents per share that you have. So if you have however many shares you have, you take that multiplied by 0.4, that's how much you're going to get for that quarter. So I'm still winning, making money because the value of the stock is more or less the same, but I'm getting dividend. Again, that's how I go and look to see what stock is right for me. Now, we're going to go through and break down the stats of what I just showed. Again, we're going to use Ford as an example because it's my favorite stock, my favorite individual company that I have. Now, I have the numbers I have on here is when I did the notes is from like a couple days ago, so it might not be what Ford is now, but this is as of, I think 2 days ago from recording this. So the name's Ford, the ticker symbol Ford is just F. Opening, which opening is what the price of it when the stock market opens. So stock market is, it is 9:30 Eastern time to 4 o'clock Eastern time, Monday through Friday, close on holidays. So Monday through Friday, stock market opens, and when it opens, it has an opening price. So opening price was $12.85. Obviously, today's high is the high it went for today, which was $13.03. The low is the lowest it was for the day, $12.65. Obviously, the 52-week high is the highest it's been in 52 weeks, $16.68. 52-week low is $10.61. So again, for the price it is now, it's like right in between. So it's fairly discounted price if you're looking to buy. The volume, you'll see volume on there. Volume is shares, the total shares that have been traded for the day. So at the time, it had been 23.48 million. So that means 23.4 million shares of Ford had been traded at that point during the day because it was like later in the afternoon. Average volume is the average amount of shares traded per day. So generally, on average, Ford shares get traded, 53 million shares get traded a day. Market cap, if you hear people say market cap is the total value of all the company's shares of stock. So if you take all the shares of Ford, if you could buy the entire company and buy all of its shares, it would cost $51.9 billion. That's basically the value of the company, is $51.9 billion. Price earnings ratio, it's a little complicated kind of. It's the price of a share of a stock divided by the company's earnings per share. I wouldn't get too much into that. Just know that it's pretty much, it's just the price of the company for the earnings. So the higher this number, that means it's a better price to earnings ratio. So ideally, you want to get a company for a good price that has a good earnings ratio. If it's negative, that means the company's losing money, but just because it's negative doesn't mean it's always negative. Sometimes it changes, but that's going to be dependent. So I know like Ford right now is negative 25, but the reason why it's negative, so again, this is where you kind of got to do more research. The reason why it's negative because Ford is putting a lot of capital, a lot of money back into the company because it's trying to expand its electrical vehicle market. It's trying to compete with Tesla. So they're putting a lot of money back into the electric vehicle market. So I understand that, but I've been invested in Ford, so I know it's not always negative. It's negative now because of that, but generally it's good. And a good P to E ratio is what it's called. Is anything above 15 or 20, anything above that is good. But yeah, that I wouldn't get too like crazy, like knocked up about. Just know if it's 15 and it's positive, okay, you know, or you might have to look up the history of that one. Dividend yield, which is my favorite. Again, I said their dividend yield was like 9.4%. So this is the percent of income you'll receive from having shares. Dividend yield, the percent thing it gets kind of complicated. All you got to do is just look up the expected EPS, earnings per share, and it'll just give you the number. So like I showed you with the Ford, it says dividend is 9.43%, that they're expected is going to pay 40 cents a share. You can just look that up instead of having to like calculate the percentage. But a good dividend yield is anywhere from 3 to 5%. So Ford is obviously at 9, which is great. That's one of the reasons why I love it. But you do be careful because some companies will have a super high dividend yield of like 15 to 20%. Those are called dividend traps. Because if a company's giving out that much dividends, that's less money to go back into the company. So generally those companies either don't make much money or they don't have enough money to actually grow the company, because that money that gets distributed back to shareholders doesn't get put back into the company. And then some companies that don't pay dividends, a lot of those companies grow because the money they make, instead of paying it out to shareholders, it goes back into the company. So there has to be a good balance. Don't fall for dividend trap. If you see a stock that has a dividend of 20%, do your research on that company to make sure it's not a dividend trap, because some of them are legit traps. You'll buy it, and then after 10 years, it will have depreciated so much. Even though you're getting a bunch of dividends every quarter, the checks are pretty good, but I fell into a dividend trap, so I'm talking out of experience, where it was paid, I think it was close to 20%, and the stock was dirt cheap. It was like $1 something. So I was able to, the time I didn't have crazy money, so I wasn't putting a lot of money, but $1, I was able to buy so many shares to where every quarter I was getting $40 something a quarter, but it depreciated so low, it became a penny stock. So I ended up but luckily I sold it before it got to that point where I lost all my money. But I'm telling you from experience, be careful with the dividend traps. They're great, but I would rather take a 5% dividend yield from a company that's also going to grow and exist down the road than to take 20% dividend from something that's just killing my money. Because every dollar I put in, I was losing more in depreciation than I was able to make on my dividends. So be careful with those. And then obviously I showed you on the performance, you can look at the 1 day, 1 week, 1 month, 3 months, a year. Some of them have 5 years, some of them have max, or like a 10, 15 year period. Again, that's what I look to, because in long-term investing, it doesn't really matter what it does that day. It doesn't even really matter what it does that week or that month. How has it done in 5 years? Because generally, if it's gone up 10% in 5 years, you can expect, or you can speculate or estimate that it's going to go up another 10% the next 5 years. So 10 years, you can expect to be up 20%. That's kind of how you can judge that, because 5 years is a decent time frame to take that average and apply it to the next 5. Generally, there's always risk. Some companies have some company like BP takes a huge hit with the oil spill. Their stock drops like massively. You know, things happen like that. But generally, that's how you can make a good estimate on how to invest or what to bet. And that's what I look at, because when I buy a stock, I'm holding, obviously, besides like Snapchat, because it did terribly, or that dividend trap. If I buy a good performing stock or a good performing company, I'm holding that thing until I retire. Because not one, the dividends, and two, it's also going to grow. So it's a double whammy. It's going to increase my value. And while it's making me money and appreciation, it's giving me a check every quarter through dividends. That's how I operate my investment portfolio. That's how I determine what I'm going to invest in. Now, how much should you invest? The general rule of thumb that a lot of these experts say that I've been watching or reading is at the minimum 10%, 10% of your check. If you can do 10%, that's great. If you can do more than that, that's fantastic. You'll get to that financial freedom, that generational wealth, that retirement, whatever your goal is, you'll get there faster. I always say, since I started in a position where I didn't know what I was doing, and I started in a position where I didn't have a lot of money to invest, literally whatever you can afford. If it's $1 a check, start with $1 check. If it's $5 a week, $5 a month, do that. Whatever you can start with, and do consistently. Because don't put $20 in, and then next thing you know, you put $20 in 6 months down the road. Do $20 consistently. If you can do $20 every check, every time that check hit, $20, throw it in the Acorn, throw it in the Robinhood, throw it wherever, brokerage, wherever you go. I'm just talking my personal experience, what I use, because I'm able to control my money, because I want to do it myself. That's why I used Acorn, and now that's why I use Robinhood. I'm able to control my money. But if you're going to get Robinhood, every check, just throw $20 in there. Throw $20 in there, put it in your, however you want to set your ETF, or maybe put half in ETF, half in cash, and let the cash kind of be the foundation to stabilize the portfolio. Or, buy 2 or 3 companies, an ETF in a specific sector, and maybe the last little bit in cash. However you want to set it up, just $20, throw it in there, come up with a plan of how you can distribute it. What I do is every check I put in a certain amount, and I specifically split up that amount within the Robinhood every single time. I got it to where it's automatically just, bam, every 2 weeks on Friday, it takes money out the account and it puts it in there, and it distributes itself. Robinhood, you can set it up to automatically put money in specific places for you. So I don't have to touch anything. It just does it automatically. I got money going to my ETF every 2 weeks, money going into my Ford every 2 weeks, money a little bit, very little bit going into the crypto. Again, I'm not a fan of crypto, but I'm putting money in because I'm able to have some type of risk. Now, it's very small percent of the portfolio, but I am taking a little bit of risk, hoping though that, man, if some of these cryptos can blow up in the next 5 years, we're going to be set. But again, I'm talking very small percent of crypto. I don't even want to go there. But again, when I first started, I remember I put $5 in Acorn, and that was my first officially being in the quote unquote stock market. Officially in 2014, I put $5 in Acorn. I was officially an investor, an amateur beginner investor. And it has, gone pretty well. I've learned, I made some mistakes, but again, that's why I'm here to help you out, help you guys out that are listening. So you don't have to make the mistakes that I made, but some of it is going to be trial and error. Obviously, if you just put your money in and put in the Acorn, you're not going to be as many mistakes, but I wanted to take a little more control, made some mistakes. Just watch out for dividend traps and really, really look at the 5 to 10 year span of a company before you buy. Do your research first. It's the most important. Somebody tells you, oh, dude, you should buy. I don't care if they're an expert and they do. I don't care who they are. Just take a little bit. They say buy this company. Just look at it first. Just look at it first. If it's trended up in the past 5 to 10 years, if you're a dividend guy, not dividend, whatever. But if it's trended up the past 5 and its P to E ratio is positive, then, at least it looks good on the surface. But I just want to say, make sure you at least do your own work first. Now, again, be consistent. Whatever you can put in consistently, if you can put in $1 a week, put in $1 a week. But the most important thing is start right now. Because you can't make up the interest that you're going to make if you start today. You can't make that up in the future. That time is gone. That's how compounding interest works. If you start right now, the money you make now can never be caught up down the road. Even if you put in $1,000 at the end of the year that you didn't have now, that won't account for the money that you could have. Even if you had that, if you put $1 in now, you can only put in $1 in now. Let's say by the end of you can only put in $40, and then all of a sudden if you do that versus putting in 1,000 at the end of the year or 40 at the end of the year, let's say same amount. Let's say you can only put in $1 all the way up, whatever. Let's say you can only put in $40 now. Or you can wait to the end of the year and put in 40. That 40 now is going to make, how many more months we have? The 6 or 7 months that we have left of the year, that time frame of interest being made, that 40 of the year will never make up for that, is what I'm trying to say. Sorry, my words got a little twisted there. But that's why it's so important to start now, even if it's just $1, because this time can never be made up. Okay, now, people always ask, what do you do if you invest and you lose your money? Well, first of all, if you lose your money, there's nothing you can do. But that's why it's important to diversify. So if you diversify, let's say you just buy 10 individual companies. And let's say you buy 11 individual companies. Let's just say 11. And each company is in each sector. So you buy one company that's in utilities, one that's in healthcare, one that's in financials, yada, yada. You have 11 companies. Each company is in a specific sector. Let's say, God forbid, an entire sector hits a bombshell. Let's say the material sector hits a bombshell. And let's say that company that you bought in the material sector goes out of business, bankrupt, something happened. That you've lost, that money's gone. Once it's gone, it's gone. If you don't sell it before then, that money is gone. But that was only 1/11 of your portfolio. So yeah, your portfolio is going to go down, it's going to drop, but you won't lose all your money because the other 10 sectors are doing fine. That's why that VTI ETF or VOO, which is the Vanguard S&P 500, is essentially the same, but the VTI is the total stock market. The VOO is just the top 500. That's why that ETF is my favorite. No matter what's happening in a specific sector, I'm not gonna lose everything because the other sectors they perform independently of each other. Right now, the banking crisis, the financial sector is hurting right now. The tech sector is doing just fine. They perform independent of each other. So the stock market is just the summation of all of them together. So even if 3 or 4 sectors are doing bad, you still have the other ones that are still performing on their own. If they're all doing bad, then, that's unfortunate. But what I will say, speaking of that, what I will say is you also have to, when you're doing long-term investing, the only people that freak out when the market is going down are people that day trade, because they're day trading in a bull market, or they're day trading a bear market. They're day trading while the market's going down, so they're essentially losing every day. That's what they're doing. If you're a long-term investor, you got to have a mindset change. What you have to start thinking when the entire stock market, the economy is in a recession or whatever you want to call it, when everything's going down, you have to change your thought process. You don't freak out. You get excited. I get excited when the prices of companies go down. You wanna know why? I'm buying them on discount. They're on sale. That's how I view when the economy or the stock market goes. I know it sounds terrible because some people hurt, but if you're a long-term investor and the stock market's going down, that means the price of companies is dropping. I get excited because I'm able to buy things on sale. And we all know the Great Depression, it was terrible. The market bounced back. The 2008 recession, the market bounced back. We know as a whole, not all companies make it through it, but as a whole, the market's gonna bounce back. It's not gonna just stay at zero, right? So I know I'm buying these things low, not ETFs. I'm buying them low because I know it's going to bounce back. So if I can buy as many shares I can buy on discount, when it bounces back, I've made more. That's how wealthy people make more money during a recession than they do in a regular bull market, because they see the market go down. They end up buying all these companies and ETFs when they're dirt cheap. They buy so much at dirt cheap, their money goes longer because it's dirt cheap. It's like if you're used to paying for something that's $10, let's say $10 bottle of water. Let's say something happens to the water market and those bottled waters go on sale or roll back. If you're a Walmart shopper, let's say they go and roll back for 50 cents a bottle. The $10 you normally put to buy one bottle, you can buy so many for a penny. That's the example. You see what I'm saying? So people's money go further. They buy so much at a dirt cheap discounted price. When it bounces back to where it was, most people, when it bounces back to where it is, most people break even. Those people that bought low, when it goes back to even, they've made money. That's how wealthy people make money during times of financial crises, financial situations. You get what I'm trying to say? But I just want to throw that in. You have to change that mindset if you're a long-term investor, because in the long run, you're going to be okay. Everything's going to be all right. You just got to make sure the companies you're invested in are strong, reliable companies. That's why you have to do your research. Check their balance sheet, look up their calls, earnings, their reports, the articles, all that. But you're gonna win, is essentially what I'm saying. You just got to make sure the companies are strong to weather the storm. Okay, anyway, diversify. Don't put all your monies into one company. Again, think about investing in multiple sectors. Don't have all your money in tech. Even though tech's being lucrative right now, don't put all your money in tech, because tech might hit a point where it's going to pop, and that sector is going to, we don't know what happened. That sector might end up hitting a downturn and your money's going to go down. Don't put all your money in one company. Don't invest all in one sector. Again, you can buy ETFs to buy ETF in that sector, and then you can have money in that sector, but then buy some other ETFs or some other companies. You can do a mixture of ETFs, companies. You can have straight ETFs. You can have straight companies. However you want to do it, but just make sure you're diversified to protect yourself against depreciation. Now, personally, because I do get asked this a lot, they say, what's the simple setup? Some people will ask me, how do I get started? I tell them to download Robinhood, they'll download Robinhood. Now they're like, what do I do? Right? Because downloading the app and getting on, that's half the problem. What do I do? I think the simplest method for getting started is wherever you put money in, keep half of it in cash, because Robinhood gives you, they actually give you a interest on just the cash in there. So that cash is still making money. Put half cash, half into the VTI, and that's a good start. That's essentially how I started out. I kept half of it in cash to keep it stable, because the cash doesn't go down. If the cash will go up, because it's gonna give you the APR, the APY. I keep saying APR. It gives you the interest for having the cash. So the cash never goes up and down. That's why the cash, I call it the foundation, or it's a stabilizer. It gives you stability, because if you have a portfolio that's $2,000 and $1,000 of it is in cash, that means half of your portfolio is never going to go down. It doesn't go up. It's never going to go down, because it's not in anything that changed. It's just sitting there, right? And then now Robinhood added the I guess the feature to where for keeping cash in there, it's going to give you interest on it that's way more than banks. Then that cash not only will never go down, it will gain you. It doesn't gain much, but it will give you a little bit of money on top. So you have half of your portfolio that is rock solid, that's going to stay there. And then the other half will have a little bit of volatility, because even the most stable companies have volatility. So that's a good way to start. So, you open it up, $20, keep 10 in cash, 10 in the VTI. And I think that's a good way to build that up. And then once you get comfortable with looking and doing research, then you can start, okay, let me buy some forward. Still keeping the 2 up, still keeping the cash and the VTI. Okay, this time instead of putting money in VTI, let me buy some forward. Or I might put in a lump sum and buy some Apple or something like that. I think that's the safest way to get started. I think it's probably the easiest way to get started if you kind of don't know what you're doing. But that's what I did that got me comfortable to kind of stepping out into other things, like what did I mentioned earlier, let me keep track of time. I'm sorry, I'm drawing a blank. The dividend trap. With the dividend trap, I told you, like, I lost so much money, but I didn't lose all my money, because I only had a small percentage of my money into that dividend trap company. I don't even remember the name of it. I believe it was an energy-based company. It was like an oil rig out in Alabama or something like that. I was thinking oil, because in my head I was like, oil, oil, we're gonna need oil, gasoline. Now that's what I was thinking. And then on top of that, but what I did is I ignored the 5-year performance. The 5-year performance wasn't good. But when I looked at the dividend, I was like, oh man, this dividend yield will probably make up for the depreciation of the company, because I'll make so much money because it's so cheap. The dividend is so high. The money I lose on the depreciation, I'm gonna make back on the dividend. That's what I was thinking. So I overlooked the obvious, as it's trended down every year for the past 10 years. You should not invest in that. But I ignored that. But I was young. This is like right when I got started. But since it was such a small percentage of my portfolio, once I sold and I took the L and cut my losses, I sold all of it when it was just going down. My portfolio was still fine, because I still had money sitting in cash. I had money in my ETFs. I had money in other companies, to where I didn't have all my eggs in that basket. So some quick things before I close out. Again, this is major keys for me. How I operate my portfolio is I only buy dividend paying stocks, I only buy dividend paying stocks. On the frequency of payment, it doesn't really matter. I try to at least get quarterly, I'm not a fan of annually or semi-annually, but that doesn't, as long as they pay a dividend, I'm fine. There are some that pay monthly. I'm slowly going to get into those because I want to check every month. But I'm going to wait till my portfolio gets big enough to the point where it makes sense to do monthly, because right now we're talking like pennies per month. But versus quarterly, it's actually a few dollars. We're talking like actual money. But I only buy dividend paying stock because I want to check for owning this company or ETF. Second, ETFs. ETFs. For long-term investing, ETFs are diverse and they are simple. If you love technology, you can buy a technology ETF and you are in that market. You can see what companies you hold. Now, you can look up those ETFs. It'll tell you what companies, so you can see each company that you own a piece of. Because even through the ETF, just because you're buying an ETF and not that company directly, that ETF still owns a piece of Apple. So even though I don't directly own an Apple stock, but through the VTI ETF, I do own a small portion of the Apple stock. So I'm a partial owner of Apple. I can technically say I'm a partial owner of every publicly traded company, but nobody's gonna talk like that. But ETFs. I cannot stress ETFs enough. I love them. They're diverse. They're simple. They take out guesswork. When you're looking at individual companies, does it trend up over a long period of time? I'll go to outside of Robinhood. I believe it's some like Google or sometimes Yahoo. They'll have like the 20 year trend. I look at it, does it trend up over a long time? I got to the point where if I look at the 10 year or the 15 or however the longest span I can see, if it doesn't trend up, I'm not buying it. I'll do if it's stable to where it's, the past 10 years only gone up 2%. If it pays a decent dividend, and I look at some more like the P to E ratio is good, it pays a decent dividend, I'll consider it. But generally, if it's not up, if it's trending negative at all, I'm not buying. That's just common sense. Nobody wants to lose money over time. When you're saving up to generational wealth, financial freedom, you don't want to get to financial freedom and then every year, once you retire or quit your job, you're losing money. That makes no sense. Diversify. I always preach diversify, but with ETFs, you can essentially do that. You can diversify within a sector. You can buy all 11 sectors separately if you want, or you can buy the S&P 500, or you can buy the VTI, which is buying all of it at once, depending on how you want to do it. You can buy all 11 sectors, have a little more in one sector than the other. It doesn't have to be even either. So if you buy all 11 sectors, you don't have to have an even split in all 11. If you're going to do that, you might as well just buy the VTI because it essentially does, it breaks that down. But if you want to, you can set up however you want. That's the beauty of Robinhood. You can set up whatever you want. If you want to take out every week, put an equal amount into each sector and hold all 11 sectors separately, you can do that if that's what you want to do. Or if you want to hold all 11, but you want to put the majority into healthcare because that's something you really care about, or if you want to put the majority into utilities, then you can do that. That's what I love. You can control your own money. Be consistent. Find a consistent plan to invest consistently. Automate it if you can. Mine's automated. I don't have to think about it no more. Every time my check hits, I have it to where my automation is based on when my check hits. When it hits, it gets distributed to where I have it set up to distribute. Hands off. I don't have to think about it. And it's just going to grow over time. So diversify, be consistent, and then reinvest. In Robinhood, you can have it set up to where your dividends get to your bank account. You can have it to where it gets sent to your bank account, get sent to the cash in your portfolio, or get reinvested back into that company. Reinvest. You want to compound your interest, reinvest. Especially first getting started, reinvest. Now, when you get to the point where you have serious money in your account and you're making, livable income off of your investments, then that's when you spend the interest, not the principal. If you have $1 million in your portfolio and you're averaging 8% return on that million, that means you're gonna make $80K a year from your investment portfolio, right? Don't pull out more than $80K. Because if you keep that million in there and you're averaging 8% return a year, with that million, if you keep that million in there, that means every year you're getting 80K. But once you start taking away from that million, 80% of 90K is not 8% of 90K is not gonna get you 80K. It's gonna be less. So leave the principal. The principal is the lump sum in there that's making you the money. The interest is what you get from that money working. That's what when you hear wealthy people say, their money makes them money. That's what that means. That million is sitting in there, and for simple math, it gets you 88. I keep saying 88% return a year. That million, if you never touch it, every year 80K, every year 80K. And what you can do, that's how you retire. That's how you can reinvest till you get to that point. You spend the interest, so you're gonna have 80K in perpetuity. And that's if that million stays the same. Obviously, if the market goes up over time, that million might turn into 1.5 million because it just appreciated in value. Then 8% of 1.5 is more than 8. You see what I'm saying? That's how generational wealth starts. And then what you can do is, if you still have a job and you're making 80K, well, that 80K, you don't need all of it to live off. Let's say you only keep 20, you put 60K back into the principal. Now you got 1,060,000 making you money. So 8% on 1,060,000 is going to be more than 80. So that's how that gets reinvested. That's how generational wealth happens, to where once that portfolio gets, let's say, handed down to your kids, it might be worth 5 or 10 million, right? Now 10 million at 8%, now we're talking $800,000 a year. That's how it starts to compounding, reinvesting, compounding interest with not touching the principal. That's how the generational wealth gets crazy, right? But that's how that's the plan I have for me, because generational wealth is one of the big things I was looking for. Now, I got to get going. Appreciate you guys for listening. I hope I answered any questions for people that send me questions. I hope that makes sense. If you have anything you want to ask, reach out to me on Instagram, FLS4swag, or the IV Talks podcast Instagram, which is IV Talks podcast. YouTube, if you want to comment, like, subscribe, I like all that. If you want to share this to your friends and family, that's awesome. If you have any more questions, let me know. But this has been your boy, Uncle Strib. I've had a great time with this one because I'm really passionate about investing and spreading the word of financial literacy. But we'll catch you guys next time. I'm out.
I'm gonna chase my dreams, my life.